Paper silver versus physical silver is one of those phrases that sounds boring, right up until the market prints two radically different price tags for what people casually call the same ounce of silver. In a recent scare, futures prices fell hard while some physical markets, especially at the retail bar level, were quoting prices that looked disconnected from the screen. That gap is the story, and it matters now because silver sits at the intersection of industrial demand, global shipping, leverage, and financial plumbing. Today you'll learn A, what paper silver actually represents, B, why physical prices can temporarily detach, and C, how to monitor stress without getting swept up in rumors. The detail most people miss, and I'll come back to it later, is that physical silver isn't one market, it's a chain of forms, locations, and delivery rules. Let's set the stage in plain English. When most headlines say silver price, they're usually referencing a benchmark that's heavily influenced by futures trading and institutional flows. That market is designed for hedging and speculation, and it's excellent at producing continuous prices. But the moment you're talking about actual bars, coins, and small denomination products you can buy today, you're dealing with manufacturing capacity, dealer inventory, local taxes, shipping, insurance, and sometimes capital controls. Those frictions can make the price you pay in a shop look nothing like the price you see on a chart, especially during a demand surge. Quick disclaimer before we go further. This is education about market structure and risk, not a recommendation to buy or sell anything, and not personal financial advice. Here's the core concept. Paper markets can create exposure faster than the physical market can create deliverable units. A futures contract is a standardized promise with rules, size, quality, delivery location, timing, and most participants never want delivery. They want price exposure, often for short periods, sometimes using leverage. That's not fake by default, it's simply a different product. Physical markets, meanwhile, clear through inventories and logistics. Cause, mechanism, impact. The cause is a sudden imbalance in who wants what, exposure versus metal in hand. The mechanism is that futures can be bought or sold instantly in large size, while physical supply is constrained by inventory and fabrication. The impact is that the quoted futures price may fall during deleveraging, even as physical buyers pay up for immediate availability. If you've ever watched airline tickets change price minute to minute while the last seats disappear, you already understand the dynamic. A liquid marketplace reprices instantly, while the real constraint is the remaining inventory and the rules around accessing it. To make this concrete, here's a step-by-step way to think about a paper silver versus physical silver divergence without assuming conspiracy or guaranteed outcomes. 1. A shock hits the futures market, margin requirements rise, risk limits tighten, or a big player exits. 2. That triggers forced selling or position reductions, pushing futures down faster than normal. 3. At the same time, retail and industrial buyers may still want metal, sometimes more than usual, because they're reacting to uncertainty, currency moves, or supply concerns. 4. Dealers see demand spike, but they can only sell what they have on hand, so they raise premiums to manage inventory and restocking risk. 5. Finally, the gap narrows when one of two things happens: either physical demand cools or new supply arrives through wholesaler restocking, recycling, imports, or, where feasible, arbitrage that moves metal from one market to another. Notice what's not on that list: a need for the futures price to catch up to the physical quote. Sometimes it does, sometimes the physical premium is what compresses. Now, who does this impact? It depends on what you think you own. If you trade futures, you're exposed to volatility and margin dynamics first. If you own a silver ETF, you're exposed to the rules of that vehicle, its custody model, its creation-redemption process, and the fact that you typically can't show up and demand a handful of coins. If you buy physical from a dealer, you're exposed to premium, spreads, and liquidity when you want to sell back. Example, imagine two beginners, Alex and Sam. Alex buys a silver ETF because it's cheap to trade and fits in a brokerage account. Sam buys a tube of coins because they want something tangible. In a normal week, their prices may move similarly. In a stress week, Alex may see the ETF track the benchmark price down quickly, while Sam may notice the dealer's buy and sell quotes widen dramatically. Even if the headline chart looks calm, neither is automatically better. They're different tools with different frictions, and the mistake is assuming they behave identically under stress. So why would physical demand heat up while paper prices soften? Zoom out to macro. Silver is both a monetary metal in people's minds and an industrial input in reality. When manufacturing demand is steady, think electronics, solar components, and other uses, fabricators care about supply reliability. When inflation expectations rise or currencies weaken, some investors care about tangible assets. Meanwhile, higher interest rates can pressure precious metals by increasing the opportunity cost of holding non-yielding assets, and a stronger dollar can weigh on dollar-priced commodities. Put those together and you can get weird combinations: industrial buyers quietly accumulating, retail buyers surging in certain regions, and leveraged traders reducing risk. That mix can produce a temporary split between financial silver and deliverable, fabricated silver, even if the long-term equilibrium eventually reasserts itself. A lot of people hear premiums exploded and jump straight to free arbitrage. In practice, arbitrage is constrained by form and rules. Large wholesale bars are not the same product as small retail coins. Refining, assaying, minting, and shipping take time, and the most profitable-looking gap can disappear before a shipment arrives. Regulations matter too. Some jurisdictions have taxes, reporting requirements, or import restrictions that change the economics. And even when conversion is possible, the trade isn't riskless. You face price moves during transit, financing costs, counterparty risk with suppliers, and the possibility that bid prices fall while you're holding inventory. That's the key detail most people miss. I flagged earlier, physical silver isn't a single pool. It's a pipeline. When the pipeline bottlenecks, at fabrication, at customs, at shipping capacity, the retail price can detach from the institutional benchmark for longer than you'd expect. Let's talk about settlement and why people bring up paper claims. In many commodity markets, the total paper exposure can be far larger than the immediately deliverable inventory. That's not inherently fraud, it's a feature of how hedging and speculation net out. The risk is what happens during a scramble for liquidity. If many participants need to reduce leverage at the same time, futures prices can move violently, and the market may become one-sided. On the physical side, if many buyers want immediate delivery, dealers can run out of stock, pushing premiums up. Settlement risk shows up when a participant expects one thing, like easy liquidity, tight tracking, or delivery optionality, and learns the rules are different under stress. That's why reading the documents on any product matters. A fund can be well-structured and still not be a substitute for a box of coins. And physical metal can be real and still be illiquid or expensive to transact at the exact moment you want speed. If you're trying to be practical, don't anchor to viral screenshots of one extreme quote. Instead, track a small set of signals that tend to move before or during a divergence. Watch 1. Exchange inventory reports and whether stocks are trending up or down over months, not days. 2. Open interest and whether it's expanding rapidly, which can imply crowded positioning. 3. Reported delivery activity relative to normal levels, because rising delivery can indicate tighter nearby supply. 4. Retail premiums from multiple dealers, not just one, since single merchant pricing can be an outlier. 5. The shape of the futures curve, whether nearby prices are unusually firm versus later months, which can hint at short-term tightness. And 6. Broader liquidity conditions like funding stress and sudden changes in margin requirements. None of these are perfect, but together, they help you separate a local retail squeeze from a broader market stress. Here are common mistakes I see beginners make in a paper silver versus physical silver conversation. First, confusing a high asking price with a tradable market price. In physical, the spread matters and availability matters. Second, assuming an ETF must reflect the highest retail quote. Most are designed to track benchmarks, not the most constrained local product. Third, taking leverage lightly. Futures and options can move fast, and margin calls can force exits at bad prices. Fourth, going all in on one narrative. Yes, paper markets can be fragile during liquidity events. No, that doesn't mean every gap predicts a permanent break. Fifth, ignoring timing risk. Even if you're right about fundamentals, you can still be wrong about the path prices take, especially when positioning unwinds. So what's a reasonable framework you can use without turning this into an emotional decision? Think in choices, not predictions. 1. Define your purpose. Are you seeking short-term price exposure, a long-term allocation, or a form of insurance? Different purposes point to different instruments. 2. Learn the rulebook. If you use a fund or brokerage product, read how it handles custody, redemptions, and extreme market conditions. If you buy physical, understand premiums, buyback policies, and storage costs. 3. Size positions conservatively. Volatility and liquidity can change quickly, and concentrated bets amplify the chance of forced selling. 4. Keep optionality. Maintain some liquid reserves so you're not forced to sell assets during a stress window. 5. Use the tracking signals we covered to decide when the market is normal versus strained, and treat strain as a risk management environment, not an adrenaline sport. Mini recap before we wrap up. Paper silver versus physical silver isn't two prices for one thing in a simple sense. It's two related markets with different constraints. Futures can reprice instantly, especially during deleveraging. Physical products can gap higher when inventory and fabrication can't keep up. Gaps often close, but the path can be messy, and the rules of your instrument determine what you actually experience. If you take nothing else away, take this. Know whether you own price exposure, a claim inside the financial system, or metal you can access, and understand the costs and liquidity of each. If this breakdown helped, like the video and subscribe for more calm, practical explanations of how markets work under stress. And I'm curious, when you think about silver exposure, do you lean toward paper instruments, physical metal, or a mix? And what's the main reason? One last risk reminder. Commodities can be extremely volatile, spreads can widen, leverage can magnify losses, and policies can change quickly in stressed markets. This is educational, not financial advice.